Hi, this is Nick. Welcome to Quest. So this is the third and final video comparing whether or not you should set up as a sole trader or a limited company. Just right at the top, I'm going to re-emphasize, if your primary concern is risk, go limited, because it can help you limit the liability. So long as you're not reckless or fraudulent in the way you run the company, it will limit liability should the company fail. Right? So that's not a tax reason for setting up a limited company, but it is still a very valid reason as to why. So what we're going to do now is just lay out some numbers on the assumption that you think you're going to earn about 30 grand, right? So the 30 grand is before you've paid yourself, so we can look at the different options about how you could pay yourself as a sole trader, and then if you've got a limited company, and then you can actually see how the tax works and make your own decisions as to what you think is appropriate. Hi, so what we're going to do is just run through a couple of different scenarios so you can see to give you a rough idea of the differences between how a limited company is taxed and what you'd expect to pay and how a sole tradership is taxed. There is a health warning, and it's in the nature of these things that numbers are meant to give you an indication, but will vary according to your personal circumstances, as well as changes in the rates and thresholds. The government changes rates all the time, and your personal circumstances or the company circumstances have a massive bearing on these numbers. So please understand this is just to give you an indication. It's not necessarily going to be exactly what you pay, but it'll give you a rough idea of how all this works. So what we've set up here is, let's say your trading activity is going to earn 30k before you've paid yourself. And the options are, do you go limited or do you go as a sole trader? So let's deal with a limited company first of all. So as I say, in our scenario, you've earned 30k, and we're going to put through payroll. So that's PAYE, and if you've had a job and are used to employment, you'll understand you get a pay slip and so on. Even though you own your own company, you can still be on the payroll, you can still take a salary. And normally what guys like us would do is we would take 8164 as payroll for you, and that number takes you up to your national insurance threshold. So that's when national insurance starts to kick in. Now, one of these health warnings is the assumption we've made here is that you're working on your own. If you've got staff, that number would be different. But for the sake of the scenario, we've just considered that you're working on your own. So up to this point, you haven't paid any tax. So if you had 30k and you've put payroll through to you, and by the way, that payroll is under your national insurance allowance and your income tax allowance. So you personally don't have to pay any tax on that. So that's one of the reasons we put through, because it doesn't cost you anything in tax, but the company can deduct it from its taxable profits. So it takes 30k of taxable profits down to 21,836 of taxable profits. But unfortunately, that does have to be taxed. Corporation tax for this year, we're dealing with 2017-18. Corporation tax is 19%. So that's how much corporation tax. Big slab of £4,148.84 is going to come out of the company coffers to pay for corporation tax. So that's a tax on the company. Okay, there's our 4184 being paid. And what that leaves in the kitty is 17,687. So what does that mean? Well, we started off with 30 grand. The company's paid you 8164 through payroll, and it's paid HMRC corporation tax. So that leaves 17,687. So that's the maximum amount of dividends that the company is allowed to distribute to the shareholder. And again, one of our assumptions here is that you're the only shareholder. That might be different, but this is again just to give you an indication. So we're going to pay that out in dividends, okay? Because that's how shareholders get rewarded for investing in a company. Now, the first chunk of dividends doesn't get taxed because 8164 you've already earned, but you're allowed to earn another 3336 before you start paying income tax. And one of the things about dividends is, because it's nothing to do with employment, there's no national insurance paid on dividend. Dividend is something that investors receive, and you've invested time, effort, money in your company. So that is something that just takes you up to your personal allowance, your personal income tax allowance of 11,500, and you don't have to pay any tax on that. Then there's another 5 grand on top. And this is specifically for dividends. Everybody has a threshold of £5,000 that they can earn in dividends before they have to start paying any tax. So the first chunk comes because you're below your personal allowance of 11,500. The second chunk becomes tax-free because of this £5,000 that's available to you. But the rest, I'm afraid, you do have to start paying some income tax. Yes, some income tax on, but it's at a rate that's designed specifically for dividends. So you then start paying income tax at 7.5% on your dividends, which means you've got to pay £701.34 in income tax, and that's a tax on you as a person, not on the company. So what does that mean in total? Well, the total tax paid, and having worked with a lot of small businesses, I know business owners tend not to care whether or not it's corporation tax or income tax. They just want to know the total tax bill. So the total tax that this activity would draw would be £4,850.18, which would leave you with 25,149 in your pocket. How much do you get at the end of this activity? Is that much. Okay, so it's complicated. You can already see this is a complicated area, but essentially you earn 30 grand, you're on your own, you're the only shareholder, you'd pay that much tax and end up with that much in your pocket. Now let's contrast that now with being a sole trader. How would that work? Okay, start off with the same 30 grand. First of all, because you're self-employed, you get class 2 national insurance just because. And this £148.20, even if you made losses, even if you made not a single penny, the government deems that just because you're self-employed, they're going to slap you with a national insurance bill. Gee, thanks. So you get that before you've got out of bed. Well done. Then on top of that, you're also going to pay national insurance at 9% class 4 national insurance on anything between the 8164 and the 30 grand that you've earned. So you get a 9% national insurance bill for your activities, and then you also pay income tax. But the income tax doesn't kick in until 11,500. So you've got £18,500, which is taxable at 20%. That's on top of this 9% and on top of this £148.20. So how much tax do you actually pay? Well, tax and national insurance. So the total tax and national insurance paid is 5813.44. So the key question, of course, is how much do you end up with? Well, you end up with 24,186.56. Now, if we look at those two, what's the difference? Well, the difference is £963.26. So by running the limited company on the same set of circumstances, 30k before you paid yourself, then you save yourself £963.26 by operating a limited company rather than sole tradership. But be aware, the government is aware of this difference, and they're going to make changes soon. So from April 2018, this 5k in dividends is dividend allowance is going to come down to £2,000, and there is a strong suspicion the government's going to get rid of it altogether. They just don't like self-employed people, so they're going to tax them more. So that's going to change, and these circumstances are going to change. And as I say, I go back to the health warning that says, you know, you need to perhaps get professional advice because your personal circumstances may not exactly fit this model. But nonetheless, it gives you an indication that what taxes are incurred, what national insurance is incurred in these two areas, but the fact that there is still a saving to be associated with limited companies. It's diminishing and it will get smaller, but nonetheless, as things stand, there is still a saving. As you can see, just looking at the sheer volume of numbers on this screen, it's a complicated area. So if you need support and advice, please get in touch. I hope that's been of help. Thanks for listening.